On a quiet Tuesday in late 2024, the United States Treasury Department released a monthly report that should have been on the front page of every newspaper in the world. The report, known as the Treasury International Capital Data, contained a single line item that signaled the end of the global economic order as we know it. It revealed that the People's Republic of China had accelerated its liquidation of U.S. government debt to a pace never before seen in peacetime history. For over 40 years, the relationship between the United States and China has been the bedrock of the global financial system. It was a symbiotic arrangement where America printed dollars to buy cheap consumer goods, and China took those dollars and loaned them back to America. This cycle, often called Chimerica by economists, kept interest rates low for American homebuyers and kept factory lines moving for Chinese workers. But that cycle has now been shattered, and the data confirms that the divorce is not just theoretical, it is happening in real time. Since their peak holdings in 2013, China has dumped over $800 billion worth of United States Treasury bonds. To put that number into perspective, that is more than the entire GDP of Switzerland or Saudi Arabia, liquidated from the US balance sheet. This is not a simple portfolio rebalancing by a central bank looking to tweak its investment strategy for a few basis points of yield. This is a calculated, strategic, and irreversible geopolitical maneuver designed to insulate Beijing from the American financial system. We are witnessing the weaponization of the bond market, a silent war that is far more dangerous than any carrier strike group in the Pacific. The story of how we got here begins not in Beijing, but in Washington, D.C., with a decision that changed the psychology of the world. For decades, the US Treasury bond was considered the risk-free asset, the safest place to park money on planet Earth. Central banks around the world, from Tokyo to Riyadh, held trillions of dollars in US debt because it was liquid, stable, and legally protected. The trust was the glue that held the dollar's status as the global reserve currency together, allowing the US to run massive deficits. But in February of 2022, following the invasion of Ukraine, the United States and its allies made a decision that broke that trust forever. They froze over $300 billion of Russia's sovereign central bank reserves that were sitting in Western financial institutions. It was a display of shock and awe financial warfare, intended to cripple the Russian economy and force a retreat. While the moral justification was clear to the West, the message received in Beijing was entirely different and deeply alarming. Xi Jinping and the Politburo saw clearly that U.S. Treasury bonds were no longer a risk-free asset for a sovereign nation. They realized that if you hold your national savings in your rival's currency, those savings can be turned off with a single phone call. If the United States could seize the assets of a nuclear-armed power like Russia, they would certainly do the same to China in a conflict over Taiwan. At that moment, the safety of the U.S. Treasury market became a liability, and the rush for the exits began in earnest. Beijing realized that holding $1 trillion of U.S. debt was effectively funding the very military that was encircling them in the South China Sea. It was a strategic absurdity to continue lending money to a rival that had just demonstrated a willingness to confiscate it. So, the order came down from the highest levels of the Chinese Communist Party to begin the Great Unwinding. They began to sell off their holdings, not in a panic, but with a steady, relentless pressure that the market could barely absorb. They sold short-term bills, they sold long-term bonds, and they allowed maturing debt to roll off without reinvesting a single penny. The speed of this dumping has accelerated dramatically in the last 18 months, catching Western analysts completely off guard. Official holdings have now dropped to their lowest level since 2009, erasing nearly 15 years of financial accumulation. But the official numbers from the Treasury Department likely understate the true scale of the liquidation that is taking place. China often uses custodians in Belgium and Luxembourg to mask its true buying and selling activities from Western observers. When you look at the data from Euroclear, the massive clearinghouse in Brussels, you see a mirror image of the selling in Beijing. This suggests that the real reduction in exposure is even larger than the $800 billion officially reported. The consequences of this massive sell-off are not theoretical. They are punishing the American borrower right now, today. When the biggest buyer in the market turns into the biggest seller, the law of supply and demand takes over ruthlessly. A flood of unwanted bonds hits the market, driving the price of those bonds down and sending the yield, or interest rate, up. This is the primary reason why U.S. mortgage rates have remained stubbornly high, even as inflation data has started to cool. The Federal Reserve can cut short-term rates, but they cannot force China to buy the long-term debt that sets mortgage rates. This loss of a primary creditor forces the U.S. Treasury to offer higher and higher interest rates to attract new buyers. Who is going to step in and buy the debt that China is dumping, especially when the U.S. deficit is exploding? The answer is that there is no single buyer large enough to replace the demand that came from the Chinese export machine. This creates a structural floor for U.S. interest rates, meaning the era of cheap money is gone, and it is likely never coming back. But the story gets even darker when you look at what China is doing with the cash they generate from these sales. They are not converting their dollars into euros, nor are they buying Japanese yen or British pounds. They are not trusting any fiat currency issued by a Western ally that could participate in future sanctions. Instead, they are executing the largest accumulation of physical gold that the world has seen since the Second World War. For 18 consecutive months, the People's Bank of China has officially announced an increase in its gold reserves. And just like their debt selling, the official numbers on gold buying are likely a fraction of the reality. Industry insiders in Hong Kong and Switzerland report that massive shipments of bullion are moving quietly into mainland vaults. This gold is being removed from the London and New York exchanges and shipped physically to Beijing and Shanghai. This is a critical distinction because paper gold, or ETFs, can be frozen or manipulated in a financial crisis. Physical gold bars, stored in a vault deep beneath the streets of the capital, cannot be sanctioned by any foreign power. This is what financial strategists call sanction-proofing, an economy in preparation for a kinetic conflict. By moving their savings from digital dollars to physical metal, China is making itself immune to the weaponized US Treasury. They are trading the return on capital for the return of capital, prioritizing safety over yield. This shift signals that Beijing believes the probability of a total rupture with the West is now higher than the probability of peace. You do not dump $800 billion of your primary trading partner's debt if you expect business as usual. You do it when you're clearing the decks for a storm that you know is coming, a storm that will shake the world. The implications for the US dollar are catastrophic, as this moves demand away from the greenback permanently. For 50 years, the dollar's value was propped up by the fact that central banks needed to hold it to trade. If the second largest economy on earth decides it no longer needs dollars, the value of the dollar must decline. We are already seeing the early signs of this de-dollarization in the bilateral trade agreements China is signing. They are paying for Saudi oil in yuan, they are paying for Brazilian soybeans in yuan, and they are paying for Russian gas in rubles. Every single one of these transactions represents a transaction that used to happen in US dollars but now does not. This reduces the global velocity of the dollar and leaves billions of them stranded in the United States, causing inflation. This is the mechanism by which China can export inflation back to the US without ever raising a tariff. By refusing to recycle their trade surplus into treasuries, they force the US to monetize its own debt. This means the Federal Reserve eventually has to print the money that China used to lend, devaluing the currency further. It is a vicious feedback loop. China sells debt, rates rise, the Fed prints money to suppress rates, and the dollar falls. As the dollar falls, commodities get more expensive, inflation returns, and China sells even more debt to protect itself. The American consumer, largely unaware of these complex capital flows, just sees the price of groceries and gas going up. They blame the president or the local corporations, not realizing the root cause is a geopolitical divorce happening overseas. The standard of living in the West has been artificially inflated by cheap goods and cheap loans from the East. Now that the East is closing the loan window, the bill for that standard of living is finally coming due. This is why the soft landing narrative pushed by Wall Street is fundamentally flawed and dangerous for investors. You cannot have a soft landing when your biggest creditor is aggressively liquidating your debt to prepare for war. The $800 billion that has already left the system is just the opening salvo of a much longer attrition campaign. China still holds roughly $800 billion more, giving them a nuclear option in the bond market. If they were to dump the remainder of their holdings in a single week, it would freeze the entire global banking system. It would send US interest rates to double digits overnight and likely trigger a depression in the United States. Beijing knows this, and they use the threat of this sale as leverage in every diplomatic negotiation with Washington. But they are also racing against time, trying to get out of the dollar before the value collapses completely. They are in a trap where selling too fast hurts the value of what they have left, but holding on is too risky. So they have chosen this steady, grinding pace of liquidation that drains liquidity from the West month by month. This creates a slow bleed for the US economy rather than a sudden heart attack, but the end result is the same. The financial dominance of the United States, built on the ubiquitous demand for Treasury bonds, is eroding. We are moving from a unipolar financial world to a multipolar one, where gold plays a central role again. The incredible stability of the last 40 years was an anomaly of history, not the permanent state of affairs. We are returning to a more volatile, fragmented world where nations do not trust each other's currency. The $800 billion exit is the clearest signal yet that the era of globalization is officially dead and buried. Investors who are still holding a traditional portfolio of stocks and bonds are standing on a crumbling foundation. The bond market, which was supposed to be the ballast of the portfolio, has become the epicenter of the risk. And the one asset that has no counterparty risk, the one asset China is buying, is the one most Americans ignore. As we look at the charts, the correlation between Chinese selling and the rise in the gold price is undeniable. It is a direct transfer of wealth from the fiat system of the West to the hard asset system of the East. This is not a conspiracy theory. It is a mathematical certainty visible in the TIC data for anyone who looks. The alarm is ringing, but the mainstream financial press is hitting the snooze button, hoping it goes away. It will not go away because the geopolitical drivers behind it are only intensifying with each passing month. The dumping of debt is the symptom. The disease is the total breakdown of trust between the world's two superpowers. And as this trust evaporates, the mechanism that funded the American empire is being dismantled brick by brick. The question now is not if China will sell the rest, but when they will sell it and what triggers the final dump. To understand that, we have to look at the global reaction to this move and the rise of the BRICS alliance. To fully grasp the magnitude of what comes next, we must look beyond the bilateral relationship between Washington and Beijing. The decision by China to dump US debt is not happening in a vacuum. It is the catalyst for a global realignment. For decades, the United States enjoyed a unique privilege where it could print money and the rest of the world would absorb it. This system, often called the exorbitant privilege, relied entirely on the perception that the US dollar was a neutral utility for global trade. But when the G7 seized Russia's reserves in 2022, they effectively politicized the reserve currency, shattering that illusion of neutrality overnight. The fallout from that decision has created a wave of anxiety that has washed over every capital in the global south. Leaders in Brazil, South Africa, India, and Saudi Arabia looked at their own dollar holdings and felt a sudden chill of vulnerability. They realized that their sovereign wealth was only theirs as long as they remained in the good graces of the US State Department. This realization has breathed new life into the BRICS alliance, transforming it from a loose talk shop into a formidable economic bloc. China is no longer acting alone. It is the primary architect of an alternative financial infrastructure that excludes the Western banking system. The dumping of US Treasuries is the funding mechanism for this new architecture, moving capital from the old system to the new one. We are seeing the rapid development of parallel payment systems like CIPS, which is China's answer to the Western SWIFT network. CIPS allows nations to trade with each other directly, settling transactions in yuan, rupees, or rubles without ever touching a US dollar. This bypasses the US banking system entirely, making American sanctions completely toothless against any nation that uses it. The volume of transactions on this alternative network is growing exponentially, driven by the fear of future weaponization of the dollar. But the most critical pillar of this new system is not technology. It is the alliance with the world's energy producers. For 50 years, the Petrodollar agreement with Saudi Arabia was the anchor that kept the global financial system centered on the United States. In 1974, the US agreed to provide military protection to the kingdom in exchange for the Saudis pricing all oil sales exclusively in dollars. This created a synthetic demand for the US dollar as every nation on earth needed dollars to buy energy to power their economies. That agreement is now effectively dead, killed by the shifting geopolitical priorities of the Middle East and the rise of Asia. Saudi Arabia's leadership has made it clear that they are no longer monogamous to the United States when it comes to trade. They have publicly stated their willingness to trade oil in currencies other than the dollar, specifically the Chinese yuan. This is not just rhetoric. We have already seen test transactions completed for liquefied natural gas settled in Chinese currency. When China pays for energy in yuan, they are closing the loop on a commodity-backed currency system that rivals the dollar. But the skeptics on Wall Street always ask the same question. What is Saudi Arabia going to do with all those yuan? They argue that the yuan is not a freely convertible currency and that nobody wants to hold billions of them in reserve. This is where the Shanghai Gold Exchange comes into play, a mechanism that most Western analysts completely ignore or misunderstand. China has created a mechanism where oil exporters can convert their yuan revenue directly into physical gold on the Shanghai Exchange. This effectively creates a gold for oil barter system. With the yuan acting merely as a temporary medium of exchange, it solves the trust problem because the Saudis do not have to trust the Chinese government or hold Chinese currency for long. They can trade their black gold for yellow gold, bypassing the US dollar and the US Treasury market entirely. This is the nightmare scenario for the Federal Reserve because it permanently removes demand for US debt from the global system. If the energy trade de-dollarizes, the structural demand for the dollar collapses, and the value of the currency must re-rate lower. This is why we are seeing such aggressive gold buying from central banks. They are preparing for this new settlement mechanism. The BRICS nations are actively discussing a new reference currency backed by a basket of commodities, including gold and oil. This unit of account would allow them to trade with each other without the exchange rate volatility of their individual currencies. It creates a commodity firewall that protects their economies from the inflation that is rampant in the Western fiat system. The expansion of BRICS to include major energy producers like Iran and the UAE further cements this commodity-centric alliance. They now control a significant percentage of the world's oil, gas, and food production, giving them massive leverage over the West. While the G7 controls the financial printing presses, the BRICS nations control the tangible resources that actually run the world. In a conflict between the financial economy and the real economy, the side with the energy and food always wins eventually. This shift is forcing Europe into an incredibly uncomfortable and dangerous position between two colliding tectonic plates. European leaders are waking up to the reality that blindly following US sanctions policy is destroying their own industrial base. They have lost access to cheap Russian energy, and now they risk losing access to the massive Chinese export market. We are starting to see cracks in the transatlantic alliance as European leaders visit Beijing to secure their own trade deals. They know that if the US dollar system falters, Europe does not have the unified strength to weather the storm alone. The euro is a derivative of the dollar system, and it will suffer even more acutely if the global reserve status fragments. Meanwhile, in the global south, the message of de-dollarization is resonating with populations tired of imported inflation. Countries in Africa and Latin America are burdened with dollar-denominated debt that becomes harder to pay as US rates rise. They view the US Federal Reserve's interest rate hikes as a form of economic aggression that bankrupts their nations. China is offering them a way out, presenting itself as the benevolent partner willing to restructure debt and trade in local currencies. This is a battle for hearts and minds, and right now, the US is losing the narrative war in the developing world. The dumping of US Treasuries by China is the signal to these nations that the hegemon is bleeding and vulnerable. It emboldens them to push back against IMF austerity measures and seek alternative funding sources from the new development bank. This bank, headquartered in Shanghai, is the BRICS equivalent of the World Bank, lending for infrastructure without political strings attached. It is funded by the very surpluses that China used to recycle into US Treasuries, completing the diversion of capital. The money that used to fund US budget deficits is now funding ports, railways, and power plants in the developing world. This builds a physical network of trade that binds these nations to the Chinese economy for the next century. The Belt and Road Initiative is not just about concrete and steel, it is about creating a closed-loop economic system. In this system, Chinese standards, Chinese technology, and Chinese money become the default operating system for trade. The US response to this existential threat has been surprisingly slow, disjointed, and oftentimes counterproductive. Washington seems paralyzed by political polarization and unable to formulate a coherent grand strategy to counter this shift. Instead of strengthening the dollar by balancing the budget, the US government is running record deficits that erode trust further. They are weaponizing the dollar even more aggressively, using sanctions as the primary tool of foreign policy. This is the equivalent of a store owner beating his customers. It only encourages them to shop somewhere else faster. The more the US uses the dollar as a stick, the faster the world moves to build a shield against it. China's dumping of $800 billion is merely the first major defensive wall being erected in this new financial fortress. We must also consider the role of digital currencies in accelerating this transition away from the legacy banking system. China's central bank digital currency, the ECNY, is the most advanced in the world and is designed for cross-border trade. It allows for instant, programmable settlements that can completely bypass the correspondent banking network controlled by the US. Project mBridge, a pilot program involving the BIS and several central banks, is testing these cross-border digital transactions right now. The results show that digital currencies can reduce settlement times from days to seconds and cut costs to near zero. But the real feature is privacy from the prying eyes of the US Treasury's Office of Foreign Assets Control. If a transaction happens on a blockchain between Beijing and Dubai, Washington may never even know it occurred. This technological obsolescence of the US surveillance state is a major driver of the panic we see in intelligence circles. They know that once the financial data goes dark, their ability to enforce sanctions evaporates completely. The combination of gold-backed trade and digital settlement rails creates a formidable alternative to the dollar system. It is a barbell strategy, combining the oldest asset in the world, gold, with the newest technology, blockchain. This hybrid model is robust, resilient, and incredibly difficult for the United States to attack or disrupt. The window for the US to stop this transition is closing rapidly, if it has not already closed. We are moving toward a bifurcated world economy with two distinct spheres of influence and two distinct reserve systems. One sphere will be dollar-based, debt-based, and centered on the military alliance of NATO and the G7. The other sphere will be commodity-based, gold-backed, and centered on the economic integration of the global south. The friction between these two spheres will create volatility, trade wars, and potentially kinetic proxy wars. Investors who are positioned for a unified global economy will be blindsided by the inefficiencies of this new reality. Supply chains will be duplicated, costs will rise, and the efficiency gains of the last 30 years will be lost. This is the great stagflation that many macroeconomists have been warning about, driven by deglobalization. The Chinese selling of treasuries is the funding mechanism for the separation, the alimony payment of the divorce. It is the tangible evidence that the two economies are untangling their deep interdependence regardless of the cost. China is willing to take a short-term loss on its bond portfolio to secure long-term sovereignty and survival. They view financial independence as a matter of national security, more important than GDP growth or stock market returns. This is a mindset that Western Wall Street types struggle to comprehend because they think in quarterly cycles. Beijing thinks in generational cycles, and they are willing to endure pain today to win the decade. The $800 billion that has left the U.S. bond market is capital that is never coming back to fund American consumption. It has gone forever, redeployed into gold mines, oil fields, and strategic alliances that strengthen the rival bloc. This leaves a massive hole in the U.S. government's balance sheet that must be filled by someone. And as we will see, the only entity left to fill that hole is the American saver and the American taxpayer. The consequences of this shift will not stay overseas. They will land squarely on the kitchen tables of the American middle class. The inflation we have seen so far is just the tremor before the earthquake. To understand the domestic endgame, we have to look at what happens when the bond vigilantes finally wake up. We have explored the geopolitical divorce and the rise of the alternative financial system, but now we must bring the story home. The most dangerous misconception among American investors is that this financial war is happening over there, far away from their daily lives. They believe that the selling of bonds in Beijing or the trading of gold in Shanghai is abstract macroeconomics with no real-world impact. But the reality is that the consequences of this $800 billion liquidation are already sitting at your kitchen table. When China stops buying U.S. debt, the United States loses the subsidy that has allowed it to live beyond its means for 40 years. We have grown accustomed to a world where mortgage rates were 3% and car loans were virtually free. That world was not a natural phenomenon. It was a byproduct of the recycling of trade surpluses from the East to the West. Now that the recycling has stopped, the artificial suppression of interest rates has stopped along with it. This is the primary reason why the average American family can no longer afford the average American home. The bond market, stripped of its biggest price-insensitive buyer, is forcing rates to a level that reflects the true risk of U.S. inflation. This is the return of the bond vigilantes, a market force that disciplines governments who spend too much money. For decades, the vigilantes were asleep because the central banks were buying everything in sight to suppress volatility. But now, with China selling and the Federal Reserve trying to shrink its balance sheet, the vigilantes are back with a vengeance. They are demanding a higher return for holding U.S. paper because they see the deteriorating fiscal situation in Washington. The U.S. government is currently adding $1 trillion to the national debt every 100 days. This level of spending was once reserved for world wars or economic depressions, but now it is the baseline for peace and prosperity. In the past, we could rely on foreign nations to buy this debt and fund our deficits without asking questions. But today, the auctions for U.S. Treasury bonds are becoming increasingly difficult to clear without offering higher yields. We are seeing tailing auctions, where the government has to pay more interest than it expected just to find buyers. This is the market screaming that there is too much supply of debt and not enough demand to absorb it all. When the government has to pay 5% interest on $35 trillion of debt, the math breaks down rapidly. Interest payments on the national debt have already surpassed the entire defense budget of the United States. Within a few years, interest payments will likely become the single largest line item in the federal budget, exceeding Social Security. This creates a doom loop, where the government has to borrow more money just to pay the interest on the money it already owes. To attract buyers for this new debt, they have to offer even higher rates, which makes the interest payments even larger. It is a death spiral of fiscal dominance that eventually ends in a currency crisis or a default. Since the United States cannot explicitly default because it prints its own currency, it will choose the implicit default. Implicit default means paying back the bondholders with currency that has been significantly devalued by inflation. This is where the Federal Reserve finds itself trapped in a nightmare scenario with no good options left. They know that if interest rates stay high to fight inflation, the banking system and the government budget will collapse. But they also know that if they cut rates to save the government, inflation will roar back and destroy the dollar. China's selling of treasuries removes the Fed's ability to pivot without causing a currency crisis. In the past, when the economy slowed, the Fed would cut rates and print money, and the world would accept it. But now, if the Fed prints money while China is selling, the flood of dollars will have nowhere to go but into domestic prices. This is the recipe for 1970s style stagflation, but with debt levels that are significantly higher than they were 50 years ago. The great moderation of steady growth and low inflation is officially over, replaced by the great volatility. We are entering a period where the cost of capital will remain structurally higher for the rest of the decade. This changes the valuation of every asset class, from real estate to the stock market to your retirement account. The passive investing strategy that worked so well during the era of globalization will likely fail in this new era. You cannot just buy the S&P 500 and forget about it when the geopolitical foundation of the market is crumbling. We are watching a redistribution of wealth, from the holders of financial assets to the holders of hard assets. This is why we see Costco selling out of gold bars and central banks stacking bullion at record prices. The smart money understands that in a debt crisis, the only asset that is not someone else's liability is gold. The $800 billion exit by China is the signal that the smart money has already started to move to the exits. The retail investor is always the last to know, and usually the one left holding the bag when the music stops. Do not let that be you. Look at the data and understand that the game has fundamentally changed. The rules-based international order is fracturing into competing blocks, each with its own financial rules. This fragmentation creates inefficiencies, higher costs, and a persistent drag on global economic growth. We are moving from just-in-time efficiency to just-in-case redundancy, which is inherently inflationary. Companies are building duplicate supply chains, hoarding inventory, and bracing for further disruptions. This is the economic cost of the new Cold War, and it is a tax that will be paid by consumers worldwide. The United States still has incredible strengths, including technology, energy independence, and favorable demographics. But financial mismanagement and the weaponization of the dollar are squandering those advantages rapidly. The path we are on is unsustainable, and the market is finally forcing a reckoning that politics tried to delay. The selling from China is not the cause of our problems. It is the mirror reflecting our own fiscal irresponsibility. We spent decades outsourcing our manufacturing base and financing it with debt sold to our strategic rival. It was a strategic blunder of epic proportions, and now we are dealing with the painful unwinding of that trade. The danger now is that as the economic pain increases, the political temptation to lash out will grow. History teaches us that trade wars often turn into currency wars, and currency wars often turn into hot wars. The dumping of treasuries is a form of economic warfare, a siege on the US government's ability to fund itself. If Washington feels cornered by a debt crisis, the risk of military distraction increases significantly. This is why the situation in Taiwan is so critically linked to the bond market data we discuss. China is hardening its economy against sanctions because it anticipates a moment where sanctions will be inevitable. They are willing to sacrifice short-term economic growth to ensure their long-term survival and sovereignty. This is a level of strategic resolve that Western policymakers consistently underestimate to their own peril. We must stop listening to the comforting lies of the soft landing and start preparing for the hard reality. The dollar is slowly losing its exorbitant privilege, and with it, the American standard of living will decline. It will not happen overnight in a dramatic Hollywood-style collapse, but in a slow, grinding erosion of purchasing power. Your dollars will simply buy less food, less energy, and fewer services with each passing year. This is the hidden tax of inflation, used to pay for the debts that can never be repaid honestly. The solution for the individual is to become your own central bank and diversify out of the system. You must own things that cannot be printed, devalued, or sanctioned by any government. The $800 billion signal from China is the loudest warning bell you will ever hear in your financial life. It is telling you that the creditor class is losing faith in the debtor class, and they are demanding their money back. When the biggest whale in the ocean changes direction, you do not argue with it, you swim with the current. The current is moving away from fiat currency and toward tangible value, energy, and commodities. The era of the purely financialized economy is ending, and the era of the real economy is beginning. Those who recognize this shift early will protect their wealth, while those who ignore it will be inflated away. The decoupling is painful, dangerous, and messy, but it is also the undeniable reality of our time. We are watching history being made in the ledger books of the Federal Reserve and the People's Bank of China. Do not be distracted by the political circus. Keep your eyes on the bond yields and the gold flows. That is where the truth lies, and that is where your financial future will be decided. Thank you for sticking with me through this deep dive into the most critical financial story of the decade. We have peeled back the layers of the global economy to show you the engine that is sputtering. Now it is up to you to take this information and use it to safeguard your family and your future. If you found value in this analysis and want to stay ahead of the curve, I need you to take action. Make sure you hit that subscribe button right now so you never miss an update on the global economy. Turn on the notification bell because These stories are moving fast, and you need to be the first to know. We do not just read the news on this channel. We analyze what the institutions are trying to hide from you. If you learned something new today, smash the like button to help us beat the algorithm and spread the truth. Share this video with anyone who thinks the global economy is just business as usual. Keep your eyes on the data, trust your instincts, and never stop asking the hard questions. We will continue to track this situation and bring you the numbers that actually matter. This is Finance Mind, signing off. I will see you in the next video.